You've got Lemonade, Palantir, Snowflake, all down, 48%, 40%, 36%. Zillow, Redfin, Teladoc, DoorDash, Fiverr, Chewy, these are all down 25+% in 2 weeks. Hello, and good afternoon, good morning. No, I'm not going to do that. We're not doing that. Hello, everyone. Welcome to episode 6, 7?
7.
7, wow.
Yeah.
Okay. Well, we've been here for way too long already.
Bit of mind fog.
Yeah, exactly. We've been, cranking up the views recently, which is quite pleasant to hear. And today we're going to talk a little bit about the rotation, which has clearly been happening in the last 2 weeks from sort of tech and into value, which has made this man very happy and very arrogant. But we're going to try and unravel some of that today. We're then also going to discuss the new ETF, the Buzz ETF, which I don't actually know very much about, but it's Dave Portnoy, is it not?
Dave Portnoy, the man, who, I mean, not that I want to get demonetized particularly, but I think he had a bit of a run-in with some explicit pictures of himself being leaked on the web.
Wait, really? I didn't hear about this.
Yeah, so I mean, quickly to go into it, is this blackmail gate. So
it's quality content.
Yeah, Portnoy is quite a divisive figure. But he's had a couple of run-ins with people taking some explicit homemade tapes of his and leaking them onto the web.
Well, what? From outside or from inside?
No. Things that he's recorded. I should know. But nothing illegal of that nature. But anyway. So Portnoy basically, I think he sent a photo of him, in all his glory, as we might say. And this hacker called Louis Vuitton XO, that's a real name, yeah, of course, basically got his hands upon this and is trying to blackmail him. And Portnoy, in usual,
none of it. None of it.
No, he just posted it on his story. He doesn't care. No, not the explicit photo, but like the whole conversation. He's like, you know what? I've been leaked like 5 times.
But isn't that what they do? They're just like, I've been leaked.
Yeah.
I don't give.
Yeah, I mean, I don't know. The thing is I wouldn't say I'm too in touch with this industry. I'm much more of a straight shooter, so I'll defer to the expertise of other people. Okay, Kush, you tell me, what do you think
about blackmail gate?
Yeah, about blackmail gate.
I mean, I think he handled it well, not trying to pay anything off.
Yeah.
What was the ransom?
Yeah, as you said, he's used to it all. So.
Yeah, I don't know. I think the ransom was like heavy. It's like always in the tens of thousands. And the other thing is like, whenever you pay a ransom, in many ways it's an admission of guilt. Like he's done something wrong. And Portnoy, I think, would rather die than admit that he's done anything wrong or that he wouldn't do.
Yeah.
Like that's the one thing he's that's one of the many things he's very steadfast on.
But I mean, I think he's not denying that he took the videos.
No, far from it. I think he's quite proud of some of them.
There's nothing inherently wrong with recording. I mean, it's not...
Yeah, I mean, it's not hurting.
It's not everyone's
anyone,
cup of tea, but it's not like, you're not declaring war.
But it's very on brand as well for Barstool. I mean, he's positioning himself, yeah. But anyway...
Nice little intro there. I've been told to tell you all to like and subscribe, so you should do so, especially if you want to hear more content about, Dave Portnoy's glory.
Yeah.
But let's move into kind of what we were planning to talk about for the first segment of the show. So, I mean, I can't give you exact numbers here, but the S&P and the Nasdaq have taken a serious fall the last couple of weeks off sort of January 2021 highs, and particularly actually within the Nasdaq, the kind of what I would call tech growth, or I would even venture to call it the ARK ETF stocks, have really taken a hammering. So actually, I have some numbers up here. Which, look, we don't prepare anything on this show, you know that already. Let me pull them up here. So, okay, ignoring BlackBerry, which is basically a victim of the GME thing in Virgin Galactic, you've got Lemonade, Palantir, Snowflake, all down, 48%, 40%, 36%. Zillow, Redfin, Teladoc, DoorDash, Fiverr, Chewy, these are all down 25+% in 2 weeks. So, that's wiping up a quarter of the market cap of these companies. Like, this is some serious correction that we've seen happening. And then even at the bottom, you've even got companies which are profitable. PayPal, AMD, which are kind of what I would regard as slightly more conservative growth tech versus like, DoorDash or Roku or Shopify. And those guys have been declining, 22%, 20%.
And the funny thing is, I mean, maybe you guys can check out our last episode, but we did issue a sort of cautionary tale against Peloton, and lo and behold, what happened? Peloton was below 100 on Friday. I think it's rebounded to above 100. But I mean, that's basically 40% off its highs. I mean, that's insane. But I think in my opinion, and I'll hand over back to Dave, I wonder what he has to say, and Kurosh, but I think taking a bit of this excess froth off the market is probably quite good in the long run.
Yeah.
Because things were starting to get crazy, and with a new stimulus passed, they could have really gone into the insanity levels.
Yeah, I mean, I think so. I was actually reading something about kind of prolonged bull cycles, which is kind of what the economic historians are calling this. And I mean prolonged, like not like it started in 2018, like since 2008.
Yeah.
Kind of thinking it's been a really, really long, steepened cycle. And you're always going to generate economic growth in the long run, and there's a wealth effect which comes from an appreciating stock market. So as the aggregate price of the S&P rises, for example, people's investments go up, their 401ks go up, they're able to spend more money. So it has a really positive wealth effect on the country. And then every once in a while, on the country, I say on the world, every once in a while, read 2008, read 1989, read 1929, you have, really serious events where you have basically, prolonged corrections for like half a year, whatever. And the biggest question really is like, when is this next one going to happen? And it's the question which basically most professional investors have to ask themselves throughout their career, because they're only going to experience 2 or 3 of these in their entire professional career.
Yeah.
Maybe even less when they're actually managing money, because you only really start to manage money towards the end of your career. And yeah, it's all about timing the market, because what you could say is, it's getting very overvalued now. We're seeing incredible speculative frenzy, this GameStop thing, this SPAC thing. You can look at all of that and go, this is all recession indicators. In fact, have you seen those memes online?
Yeah.
It's like, not Dave Portnoy so much, but like, stock memes is a recession indicator or something. Like, a lot of these things are telling recession indicators, but at the same time, you could have been saying that 2 years ago, and you could have hedged your portfolio 2 years ago, bought into like bullion or something stupid, and you could have sat there and been like, I'm the bear here, and I believe it's going to crash, and you would now be, well over 200% in the red. Yeah. Well, not in the red, but you wouldn't have accrued the same gains that the rest of the world has accrued. So how do you time that?
I think, and I'm interested to hear what Kush has to say, I think Warren Buffett, I mean, not to jump on the bandwagon, but I think he has a lot of very instructive lessons on this. I mean, he talks about one thing, it's like, and I believe him, to a certain extent, it's very difficult to ever time the market. The market gets bigger and bigger. And okay, retail is now a bigger and bigger presence, and so maybe it's slightly easier to predict retail movements. But on the whole, aggregate price shift, sometimes the catalysts are just one big dog selling, and then it's just, domino effect. And so it's very difficult to time exactly, will it be now, will it be in 3 months, will it be in 6 months? Because people are greedy, you jump on, you try and get the excess profits for as long as possible. Because all these professional fund managers, by the way, they look at Cathie Wood and they're like, wow, she's done so well. She's getting all these inflows of capital. She's getting so much good press in the media.
Yeah.
Like, we're not generating the same alpha because things are going crazy and stuff that she has. And so now we sort of we're sort of hardline. We do our own thing, but sort of we want a bit extra.
Oh, yeah. I mean, there are guys running specialized portfolios in particular industries who are getting more and more tech heavy because there's no way to generate the same kind of alpha against the benchmark. I mean, and I'm not talking about, straight up technology, consumer products. I'm talking about, say you invest in oil and gas, your portfolio might be like 25% oil and gas tech. Growth companies which are selling their technology to the oil and gas industry, or like fintech, technology companies are selling their technology to the finance sector. Yeah. And those that's like an easy way for fund managers to kind of get into technology while staying in their niche. And a lot of them are doing it, and it's not it's not a bad thing. It's just it kind of fuels the frenzy even more because PayPal is an example of a great fintech stock which will be in every single financials portfolio around the world, right? Because it's a great company, but it's also being heavily overbought by your retail investors, you guys on Robinhood, etc., etc.
Yeah, and the thing is like. I mean, going back to the point about timing the markets, it's so tricky to time it. It seriously is. And so I think the defensive and the cautious position is to be, okay, I look at valuations now. they could have another 20, 30, 40, 50% up from here.
That's
But
the
to
thing.
be honest, I'm not interested in that because the risk that I would be incurring upon myself if these things get hit, which they could easily do, is crazy. And so rather than trying to be greedy and get that little 10, 20, 30% and try and time it, I just stay out of it. I put into things that I think are appropriately valued and I wait. And if maybe these prices can significantly come down, you can think again. Because it's the classic thing. I mean, the instinct of like any investor is to buy when things are going up and sell when things are going down.
It's really poor.
But yeah, but like if you thought about it, actually it would make more sense to buy when it's going down and sell when it's going up. Because it's getting cheaper as it goes down.
Exactly.
And more
If you
expensive as
if
it
you
goes
like the
up.
company.
Yeah.
If you like the company. And I was actually just going to say, like, I was looking at some of the valuations of the big tech stuff that I actually really like. Your Googles, your Microsofts, your Facebooks, your Amazons. Looking at the valuations of some of those companies over the last 2 weeks, which I own, and I was thinking, sure I should buy more. Like, they're great companies.
Yeah.
I really like them at their current multiples. They're not trading on massive times earnings like your Teslas and your DoorDashes or your Pelotons for instance, which is trading on 300 times earnings last time we spoke. And I was looking at it thinking, I'm going to buy more, and I have. And to be honest, I think they were kind of dragged down by this whole thing. I still do think there is upside there. So I'm not saying you can't find, in my opinion, value in tech stocks. I mean, obviously it depends what you define as being value, but I think there are still really, really good plays out there. I mean, Google, like 40% year-on-year earnings growth.
Yeah.
And for a company that trades at like 40 times PE, it's 40 times earnings. So anyway, so I think there's a danger that people start lumping all these stocks into the same category. But your Google, which employs however many 100,000 people around the world, is not the same as your Peloton.
Oh, exactly. Or Apple. I mean, the amount of free cash flow they generate, the amount of cash they have on hand. Yeah. I mean, they could just buy back stock like they have done repeatedly, and just that drives up the stock price. So yeah, I think a lot of people are forgetting. And it always happens. It's like certain stocks get branched together and get brought up with the rising tides and taken down with the tide as well.
But so you get arbitrage opportunities.
Yeah, exactly.
I was going to say quickly, we discussed last week, so Apple actually has their own fund management company or asset manager to manage the amount of cash they have. I mean, imagine that. Imagine being such a strong, conglomerate business that you effectively deploy your own asset manager to manage your own funds. It's unbelievable. And also do tax evasion strategies, I'm sure.
Yeah, but avoidance, not evasion.
Sorry, yes, tax avoidance. Yeah. Yes, that's you, Tim Cook.
But yeah. Kush, I mean, I know maybe you're slightly more, I don't know if you're more bullish than us. What do you think, like, in your experience so far, what do you think you would do with your money with regards to tech?
Well, first of all, I completely agree with you about the whole tech being bundled together. And I think we'll see which ones have more value with the recovery, see which ones actually recover. The ones that were being really overbought, I don't think they'll go back up. I think they'll probably stay behind. I mean, Dave mentioning PayPal, that's a good example of what I think is a good entry point right now. But yeah, I mean, I'm not going to go around screaming buy the dip. But again, I do think there's a couple of them there which I wouldn't categorize with the rest, which were really just retail hype. And that, for me, it's a good entry point to go into.
What's the criteria for you, like, that defines between a kind of retail hype stock and something which actually has intrinsic value?
Yeah, I mean, fundamentally, I look at the price to earnings ratio, I look at potential for growth and the revenue growth, and then look at profitability. But what I also look at is momentum to make my decisions. And that's something that, I mean, Ali, for example, I know you take quite an old-fashioned route. Do you ever look at momentum to go into anything?
I mean, do you know what it is? I think, look, for one, there are many ways to make money now on the market. There are many ways to lose money as well, on the flip side of that. My take on momentum is that it does seep into a lot of our judgments, in the sense that sometimes when things are going down, we're naturally more cautious to buy, because maybe, especially if you're operating on like a margin account or whatever, you've got to sort of bear some of these things in mind. The issue with momentum is that, for me, for my investment decisions, I always try and think, okay, we're at this point X, the current share price. Where is the share price going to tend to in the long run? Okay, what's the rate of capital appreciation, i.e., how much money will I make if we discount it by the years that I'm holding this stock? Is it something that I want to invest in? And if that's the case, then that's perfect. If it's a good stock, I like the company. There's also like an appropriate maybe margin of safety in the sense that it's not that, okay, it could go up 500%, but it could also go down 90%. Like that's maybe not the thing I want to dabble in necessarily. Maybe I'd want to wait until it's a slightly more stable price, or it's maybe filled out more the valuation criteria. But so momentum doesn't really come into that because momentum doesn't affect the end point. Maybe it affects the start point, but I don't care. I just monitor, see where it is, independently of momentum, whatever moves it, whatever catalyzes price movements. And then if it's at the right price, I buy it. And then when it's at the price I think it eventually should be at, then I'll sell it. So I don't think momentum has any effect in the long run, in short.
I'm going to have a slightly different opinion, but kind of building on the same fundamentals, and that I don't think momentum actually does have that much value in the very long run. You're kind of on the very traditional model, which is not a bad model in any way, but it's sort of a very traditional investing model. Looking for value. You're looking for companies which are going to deliver you positive net present value, right, in its future cash flows. It's very, very simple. I actually think there's a lot of money to be made in momentum because there's especially these days, passive money, so index funds and stuff like that. There's a lot of weight being thrown behind certain stocks which just continue to appreciate, and if you can leverage that, you're able to kind of make money in the short term. And because I don't trade on margin and I trade with very small amounts, it's quite easy for me to get in and out. So it's not like I'm a big asset manager that's got millions in positions and who's going to have a real tough time when stuff starts to turn down. Yeah. But so I don't actively make decisions based on momentum, but I understand that, like you were saying, whenever you do make a decision, momentum kind of seeps in because you are affected in your brain. And what I just don't try and do is I don't try and cut that out necessarily, because it's not always a bad thing. Because I know that if I'm thinking it, so is the investor next door, and they're going to buy it too. Yeah. And if I just kind of follow my gut on that sometimes, because I've got such small amounts invested relative to the rest of the market, it's quite easy for me to just pull out as soon as it starts to sell.
Yeah, and the only thing I'd say on the maybe more traditional model is actually people make use of momentum in the traditional model. If momentum works downwards, which it does sometimes, and it makes things unreasonably cheap, well then, I'm more than grateful to trade on momentum. I'll buy up everything, I'll hold it, and when it reflates back to the reasonable level, then you can just sell it on. So I think I agree with you. It's definitely something. I think it's also something. I mean, day trading, I stay away from completely.
Absolutely, yeah.
Unless I'm feeling, like I haven't got my gambling fix for the day.
Something like I want to actively lose money.
Yeah, but sometimes, I think there are some short arbitrage opportunities which have some relation to momentum. Value arbitrage, which is the scenario I was talking about, where the price is pushed down by momentum and then it reflates back to normal.
You kind of use the inverse of momentum,
almost,
which is a very, very reasonable thing to do. And I think actually any value investor is looking for those opportunities where investors have been taken away by their sense of their gut feeling. Oh, it's going to continue to go up, and you go, look, I'm doing a structured analysis here. There's no way this company is going to continue to achieve 500% ROI, year on year earnings growth, and you just think this is the time to initiate a short position. But there were examples of with GameStop. I think GameStop was undervalued before all this happened.
Well, $3. To be perfectly honest, I mean, why not?
I mean, this is exactly why Michael Burry was long. He was long GameStop well before the whole thing happened, because he thought, look, this is being oversold. There's no argument. The hedge funds were overselling it; they were squeezing it down. Now, obviously, it's not worth 130 either. But that's a good example where I would have, had I known about the stock, I would have considered potentially buying it.
But I mean, but the other thing is very quickly, I shorted Tesla, for example. I mean, that maybe necessarily isn't the most conservative value play, sort of long only, sort of taking the last two puffs out of a used cigar. But I think that really, when you think about the more new school of value, aside from just getting moderately decent things for very, very cheap, like you said, it's getting some very good companies for quite cheap relative to what they'll do in the future, and also noticing when there are various, like we said, value arbitrage positions from the point the stock's overvalued or undervalued. And obviously you're careful, if you're shorting Tesla, you're not going to put the house because if it swings up 10%, then you're gone. Like you're careful, then maybe you can slowly add as it goes up and up.
And you recognise, obviously, that
in the
this
long
stuff
run
does happen.
Yeah.
You can get caught out. And I was actually going to make this point a bit earlier. Actually, just trading on margin generally. I mean, I'm not going to say I don't, because I mean I do in occasion on with the other account. I mean, and sometimes it makes sense, but most of my investing is not on margin because I actually believe that. Okay, for example, I make an investment in a company, happens all the time, and then 3 weeks later it's fallen 10, 15, 20, 30%. I want to add more. I don't want to be concerned about posting up. I don't want to be concerned about it garrotting my portfolio.
Yeah.
Right. I want to be concerned about the true value of the stock. I don't want to. It could go down. It could go down to 5 for all I care. If I still believe in the fundamentals of the company, I don't want to be concerned about what am I going to have to close out this position or whatever it is. I almost think that margin allows investors to be too impulsive in a way, and they kind of you begin to
forces you to.
This is this is a great oh my god, it's a great stock. I mean, I'm going to lever it up to 10 times leverage or whatever, and then you kind of end up getting screwed because your losses, it makes your brain tick in that certain way where you see massive red numbers and then suddenly you're out. Whereas if you don't trade on margin, it's like, okay, the maximum I can lose is the value of the position, and that's about it.
Yeah, I think definitely in the long run, it's something, margin trading, especially for very, very, very big, sizable portfolios, it's not the solution. I think it depends. So in the short run, and especially with very small holdings, I think in some cases it can be interesting just purely because if something's battered to the point where it's literally nothing and you want to just stock up, then fine. But I think I agree with you, and it's always the point that especially if you use margin and you're offered 4 times leverage, well, do not on earth, please do not take the 4 times leverage. Be grateful that you can buy maybe 1.5 times your original position and still have a lot of cash in case it falls down. But don't just classic, give you an inch, take everything. Yeah, take a mile. Be cautious with that, because then if you get burnt, you lose everything, and the stock doesn't need to go to zero to do that. It can just swing 15%, 20%.
All the investing I do is always based on what I think future growth trends will do. So I actually will rarely buy a company which I think is undervalued if I don't think it has growth potential. Yes, it might grow for the next 2-3 years, but I want to invest in companies that I think will be instrumental in the future. So that's the first criteria. And I look at all of these tech companies. I'm like, are you really changing the world?
Yeah.
No. You're providing kind of weird boilerplate technology that fits on top of it. And then the second thing is obviously the fundamentals. I would look at I want strong balance sheets. I want companies that are funded by equity. All that kind of stuff.
I think the other thing is for a number of reasons. I mean, first thing, to bring back Chamath, though we're not necessarily big fans of his. It's true. I mean, he was he sees DoorDash going crazy. It's you think the next revolution is going to be in the food delivery business?
No, of course. No, exactly.
No, I mean, for one, let's be perfectly honest. For the average consumer, when hopefully everything starts reopening, I mean, I'm not projecting the same sort of growth in the delivery industry. I mean, this isn't, and a lot of people will talk about, yes, COVID has accelerated trends towards, but it's become a bit of a buzz phrase. In reality, I think it's maybe more worth considering maybe COVID was an oasis for some companies, that it will take them many, many years to ever get back to the same revenue. And I think the big thing, I mean, it's in price to earnings, but it's that I think it's undervalued now more than ever. Margins are one thing, free cash flow is another. If you are a company that actually makes money, doesn't need refinancing and this and that and certain contingencies to actually make money. If you're a company that makes money, which then in the traditional model can one day be passed down to your shareholders through dividend or capital appreciation in the share price, then that is actually a company which I think will be sustainably priced.
Exactly.
I think that's the main criteria for me.
Okay, so you're very traditional Benjamin Graham style
But I mean, yes, but then this doesn't exclude like certain tech or etc.
Well, this is my point.
Yeah. I think it's about finding a healthy balance. And by all means, look, if you want to invest in crypto, in Bitcoin, in gold, do it. If you want to have like a small allocation towards it. But I don't think you can YOLO all your money into things. Like, and this is my opinion, Uber, a lot of people will cite it as one of the great seed investments. I'm not a big fan of the company, I'll be perfectly honest. I'm not even that big of a fan of the service a lot of the time. I think it's definitely helped people, but it loses so much. When are they ever going to become profitable? With Uber, fundamentally, it's like, when will they ever be profitable, first of all?
Yeah.
Because, you know, at some point, you can refinance. At some point, if it's not profitable, with all due respect, then it doesn't really justify its valuation. And people talk robo-taxis, all this stuff.
Okay, yeah.
But it's like, where are the competitive levers that Uber have? What, all the data they've collected? I don't know. To me, that's not a massive competitive lever. Like, when you really think about Uber as a company, constant legal issues, for example, with the TfL one that they recently lost.
Well, they now have to actually employ all drivers, so they can't have zero-hour contracts.
Exactly, because they're trying to scam out the whole gig economy, the fact that drivers were like contracted as opposed to fully employed. Anyway, aside from that, Uber, let's see how they face like financing like issues, especially if the economy goes into a bit of a downturn phase.
Yeah.
Or if their stock market maybe corrects slightly. And thirdly, it's like I was saying, where are the competitive levers? Why couldn't someone else, like we've talked about robo-taxis, why couldn't Tesla, maybe that's working on the AI, just come and sweep Uber? Why does it need Uber? Why does Google need Uber?
I think, you know...
Especially at these valuations. I mean, it's, yeah.
I keep on talking about this, but we always conflate software and technology companies.
Yeah.
So, I mean, I keep on banging on about this bloody thing, but Google is, what, in my opinion, a phenomenal company. They're basically a SaaS company, and they have innovations in loads of other spaces. So Alphabet, the parent company, they have genomic sequencing as well. They have loads of really interesting innovations, and they're obviously huge. And they have an incredible business model, massive operating leverage, right? Much bigger than your banks, your brick and mortar stuff, obviously, right? And they are a tech company that isn't even that overvalued. You look at Uber, and you're like, okay, they're a tech company. Are they a software company? No. They have an app. They actually do still have these really annoying frictional costs, and that they need to get drivers on board.
Yeah.
Their pricing model is constrained because they have so much competition. You know, Google is a monopoly. That's one of the reasons they have the antitrust lawsuit at the moment. But Uber is the furthest thing from a monopoly. People think because it's so dominant that it's going to continue to be dominant and grow as a monopoly. But the reality is the moment that their prices go up even a bit above local taxi services, like black cabs in London, I mean, they're going to be really, really squeezed to be able to retain that kind of market value.
Yeah, and that's unfortunately what they'll need to have to do to like actually make money. I mean, how else? Then are we going to wait for like some scenario where they make robo-taxis which suddenly have 100% margin? It's like...
So Dave Portnoy released the Buzz ETF this week, compiling all the market sentiment from social media. What do you guys think?
Yeah, I mean, I was interested in hearing what you had to say because I knew you were considering investing in it. And I don't know. I mean, first of all, the funny point is that one of his major holding, Penn, is in it, which I'm actually a Penn stockholder, and so is Kurosh. So, look, I think maybe we're both happy, if not so surprised, that it's going to be in there. But I think it's interesting. I mean, obviously, it took a big battering.
Did it?
The first day, yeah, and the second day. There were some issues. It wasn't allowing investors to trade it on various platforms. First of all,
so very quickly. I mean, how is this ETF being structured? Who's running the ETF?
Well, basically, it's an algorithm that's been put together, which gathers all the hot stocks which are being talked about.
Yeah. And
then every month, the portfolio is changed to the top 75 stocks.
Yeah, exactly.
So it has monthly rebalancing, fine. But what's the actual institution that's running the ETF?
Yeah, so it was initially made by a couple of guys. And essentially, an investment in Buzz ETF is an investment in this like software or like algorithm, call it what you want, that will filter out and move things around depending on sentiment. You're basically investing in how apt are these guys at sorting out this huge data set of social media and finding the things that people are actually talking about and then are most likely to put their money towards. Which is tricky, very tricky conceptually. However, it did very, very well the first year, though, I mean, everything did well. Everyone's a genius in the bull market.
Well, this is what I mean. It's kind of, I think you run the risk, if you follow this kind of social media investing strategy, you run the risk of foregoing typical due diligence, because obviously that is, we were talking about momentum trading earlier, that is the epitome of momentum trading, is literally just looking at the names which are most hotly talked about and then putting money into it. Because you can understand how if this was actually the way that people invested, all you'd end up with was bubbles. It would just be bubbles left, right, and centre.
Yeah.
Obviously, we're all fortunate that 90% of the market still actually invests based on what is going to provide them with capital appreciation and dividends. So, but it's not actually an efficient way to have a market, right? So I'm not sure whether, in my opinion, of course there's always a place for it. I'm not sure whether I would like to see it get very, very big.
Yeah, I think there's a danger if it got big. There's a big danger if it got big. If it started moving the market, then it would be the classic, dog chasing its own tail.
Exactly.
What I think is important to mention is there was another ETF, same thing, called Buzz with 1Z, which closed down in 2019. And it was following the same model. It closed down with 8.8 million in assets. And I don't know if it was a question of right thing, wrong time. But I don't know. I mean, it's something that worries me. It's also a question of, not that anyone cares, particularly in the market, out of is it ethical? You're creating no value just to make money like this, which, to be honest, I don't pay significantly much attention to be honest, because, that's an endless discussion without many, actual relevant conclusions to come to. So, whatever, I guess that's a bit of a sidebar. But, no, I think it would be interesting if you were looking at it purely from a performance standpoint. If you were like, okay, I'll allocate 0.5 or 1% of my portfolio to Buzz ETF. Let's see what it does.
I was considering initially investing in it just because it sounded like a fun thing to invest in, just a small portion. But what I realized is, okay, it did well last year, back tested, and that makes sense to me. But now, if you see the dip last week, what's going down are the things which people are talking about. Because what's going down is the growth tech and the retail hype. And the retail hype is everything on social media. So if you're going into Buzz, you're risking going down with the rest of the people who are just overbuying stocks based off hype.
Just two things quickly. First of all, how do you backtest a social media strategy ETF? Because it's not the information is not available to you. I get if you can backtest a technical strategy because the market data is in the correct format going back however much time, but you can't analyze social. I guess what do they analyze the time and date of the social media posts and that's not really true backtesting. I'm not convinced by that.
I think also that maybe the issue is also there's no transparency necessarily, because it's okay, if you looked at the way maybe more traditional asset managers do it, you can sort of reverse engineer their thinking.
Yeah.
However, with this sort of stuff, it's there are so many social media platforms, Reddit, Twitter, what else? Discord. How do you filter through all of these? How do you filter various messages? What about people just memeing? How do you try and find a conversion rate between people that tweet and people that actually take action or moves in the market? It's there are so many various transmission mechanisms that need to be looked at. It's does this affect that? Is this actually, do they mean what they're saying here? I don't know. It seems like a very tricky thing to do.
There must be a way.
I read into that, and they did say the algorithm's quite advanced, and it does filter out all the bots, all the spamming, so it doesn't get affected by that.
In which case, Korosh, it must filter out as well what you were saying. People talking negatively about. You look at stock twits. Stock twits tries to identify whether tweets are bearish or bullish, right?
Yeah.
Maybe you can set it.
I think maybe you set it when you.
Oh, you can also set it. Okay, fine. But surely they've managed to filter out the good stuff and the bad stuff. Otherwise, you could, it could be like everyone talking about Lehman Brothers in 2008.
Yeah.
Fine, but you're not going to pile your money into Lehman Brothers,
Or someone maybe slightly more like cheeky, could do something where they basically say, okay, we're going to get together with 1,000 people, we're all going to post negatively about this at the same time.
Exactly.
In the meantime, as buzz sells, we're going to buy.
Yeah,
and then we're going to like mess around basically with this ETF.
So I think on that note,
Yeah.
we will say goodbye, and I will see you next week. Please remember to like and subscribe.
Yeah.
And obviously all suggestions of stuff we should talk about and interesting things that you guys think about should go in the comments below.
Drop it in the comments. And so that's goodbye from me, goodbye from Dave.
Koosh.
Koosh?
Goodbye.
We'll edit it anyway.
Peace. Wait. Goodbye.
Goodbye.
Ready to roll.
Goodbye. Like and subscribe. Like and subscribe.